Cześć, dzień dobry, Artur Wiśniewski z stockbroker.pl. Witam Was serdecznie na Pasywnej Rewolucji i zapraszam na wywiad z Ericiem Balchunasem z Bloomberga. Będziemy rozmawiać o Johnie Boglu, czyli ojcu inwestowania pasywnego, o tym, jak zmienił Wall Street oraz pozwolił zaoszczędzić nam biliony dolarów. Zapraszam. Hello, Eric. How are you doing? Thanks for joining our conference.
It's great to be here, at least through the Zoom. Just a quick tidbit. I am from Lithuania, or at least that's sort of where my great-grandmother's from. Balchunas, you probably recognize that's a Lithuanian sounding name, and that's where I'm from. And my grandmother used to make a lot of Polish food, especially for Christmas dinner, pierogies and stuff like that. So it's a place close to my heart, I guess.
So we can say we are almost neighbors. You're an author of The Bogle Effect, the author of the book about John Bogle and how he impacted Wall Street and how he saved us trillions. Could you tell us, because I guess most of people who watch us know who was John Bogle, but just in case for those who don't, could you please tell us shortly who was John Bogle and how did you count it that he saved us trillions?
Sure. He was a unique guy because most people who are famous in the investing world are famous because they're good investors, right? Like Warren Buffett, Peter Lynch, certain hedge fund managers. Bogle it wasn't about how he played the game, it was how he changed the game, and I think for the better. And he was just basically a champion for small investors. He set up a company where the funds own the company and the investors own the funds. Now, how that company was set up is a really circumstantial, interesting story, which I go into in the book. It wasn't like he got the idea when he was a little kid or something. It wasn't a total straight line there. But anyway, once this company was set up and he saw the power of a mutually owned company, he really took it far. And nobody has copied that structure of a mutually owned asset manager since. And that was part of why I was so intrigued by the book. Like, why did this guy do this thing that is almost like an anomaly in physics? There's just no incentive to set up a company and turn over all the future profits to the customers. Doesn't really happen. So that's why he's unique. Now, that company, which I think is the root catalyst of all of the passive index fund stuff we see today, index funds were the perfect match for that structure. But index funds would have happened anyway. Bogle did not invent the index fund. What he did was marry it with that structure, and that structure, as the assets grew, instead of taking the profits, they would put them back in the fund in the form of lower fees. So over 30 years, the fees in these funds went down from like 45 basis points to like now 3 or 4. And now, once they got below 10, they started to sweep the country. Everybody just is piling into, and why not? It's like almost like you get the whole market for no cost. And that's a big deal. He did that, and now every asset manager sort of has to have an answer to this. And so you see not only Vanguard, but the effect of what it did, everybody's kind of has to copy them with cheap index funds or ETFs. And that's how the majority of assets, at least in America, are invested today. It's a little slower going overseas. But if you take all the money that's in low-cost index funds that are either Vanguards or competitors who copy them, and you look at the money where it would have been in terms of like a 70 basis point active mutual fund, and you take the difference, you do that, you take the trading costs, and you add it all up. My math has him having saved $1 trillion for investors. And that number grows by about 150 billion a year, and the 150 billion grows each year. So there's this, like, again, exponential kind of ripple growth effect from what he did. That's it in a nutshell. I don't want to overdo it, but that's sort of, I think, his big impact. As I tell people, if I had to describe his life's work, it's addition by subtraction. he sort of took this idea of a mutual fund where you charge 1%, and there's 1% in trading costs, and a broker gets it for you, pay the broker. He said, let's take all that out. We'll take the management fee out, we'll take the trading cost out, we'll take the broker out, and we'll just we'll take everything out in between the investor and the returns. And so it's that lack of friction, I think, that is ultimately his life's work, more than the father of the index fund or some of these other things. I really try to explain that out in the book, because even if Vanguard had only active funds, I believe they'd be massive, because they would be lower cost, and again, they would have removed much of the friction that stands in between an investor and their returns.
In the book, you explain very well how he saved us trillions. So investors, we can say, investors saved money, but it means that Wall Street lost money. Does Wall Street hate John Bogle for what he did? When I read your book, it's not so obvious. That's what I feel.
No, I tried to find people who would just wanted to talk trash about him, and it was difficult. Here's why. I think, I cover ETFs, and he was pretty savage towards my world. He was pretty critical towards the whole Wall Street apparatus, and he obviously cost them money. But a couple things. First of all, a lot of people on Wall Street are Vanguard investors, so they can't not like him because they're not dumb. They're like, hey, this is a great deal. So it'd be difficult to completely hate him if you were using his funds, or say like a BlackRock fund that was very low cost that sort of copied Vanguard. I mean, you'd have to acknowledge that you're getting a good deal because of him. The industry is some of the biggest passive investors. That's kind of like maybe I don't know if it's a secret, but it's logical. Again, people in the industry are smart. Now, I thought what he did do sometimes was he'd be very confrontational and savage, kind of like he'd go to an event and sort of and maybe go a little too far with how, saying how the industry is all messed up and it's all about trading and fees. And I think sometimes people tired of that, but they knew he had a point, and I think everybody thought his heart was in the right place. It's just difficult to really hate on a guy who's trying to help mom and pop investors. Like it's just tough. I mean, because everybody has mom and pops, and it's something that everybody can relate to, and he helped. And I also think if you're in this industry, I think Bogle and Vanguard has pushed everybody to become more fiduciary, whether it's putting people in better funds, whether it's maybe sharing some economies of scale. I think people want to feel good about what they do every day, and so I think Bogle increased the amount of I'm feeling good about what I'm doing for my clients, because he just sort of showed that there's a stewardship state of mind that you can make plenty of money, but you can also really help your clients and smaller investors that way. So those are two reasons. Another one is that I found that Bogle was very good about separating what you did for a living with the human being you were. So like I covered ETFs. He is not a fan of ETFs, but we generally had a nice relationship. And I could see that separation right in front of me. And then there's people like Cliff Asness, who's a world famous active manager at AQR, a quant, huge hedge fund that the fees are not cheap. And they were like close friends. And, Cliff and other people like that, I think, are able to just acknowledge that Bogle has this point of view, but really like the person, because Bogle didn't judge you as a human just on what you did. So he could be savage towards what you did, your career or your job or your funds, but also treat you as a human being with respect. And I think that those things go a long way to sort of diffusing the sort of Wall Street hating him. That said, Wall Street, over time, I used to say Vanguard's gain is Wall Street's pain, because obviously the more people go to lower cost products, the less revenue there is for Wall Street. But again, the amount of revenue on Wall Street is really high still. So it's not like putting it out of business. It's just maybe lowering it a little bit over the next couple decades.
John was father of index investing, and thanks to his activity, now the fees dropped. For example, in Europe, active managers, they charge 2%, while ETFs charge 0.2%. So it's like 10 times difference. The question is it okay that there are active funds and passive funds, and active funds are 10 times more expensive? And it's okay? Because some people say it's not okay because people are not able to compare those two and make a rational choice. So they say offering funds which charge 2% is unethical. What do you think about it?
Yeah, so it's a more nuanced than just high fees are bad. Even Bogle said if you're starting out as an asset manager and you don't have any assets, you kind of have to charge 1 or 2%, because 1 or 2% on like $1 million isn't that much money, right? You've got to keep the lights on, pay a couple people. I think what he had a problem with was when you charge 1% on $10 billion or $30 billion. There's funds here in the US that have $100 billion. That 1% all of a sudden or 2% becomes $2 billion a year. Do you really need $2 billion a year to run one mutual fund? No. And I think there's a point where those dollar fees probably should be shared in the form of lower fees. And this is a point I make in the book. Active management's biggest, the reason they were so disrupted wasn't necessarily underperformance. That was a symptom. The core problem is not sharing economies of scale. So I think when it comes to fees, it's all about how much are the dollar fees that are being taken in, and could you live with sharing some of that? And if you can, you could lower the fee. In my opinion, if active mutual funds had did this in the 90s and 2000s, when they had a ton of money, they would have banked goodwill with their investors, and they would have outperformed more, because we all know that the fees a fund charges is like pushing the active manager further away from the starting point. So if you charge 2%, you got to make that up in alpha just to get to zero. Then you got to do better than that. So by limiting the fees, you move yourself closer to the starting line if you're an active manager. And there's studies showing that over 10, 20 years, the funds that are the lowest cost have the highest beat rates over the benchmark. So had active shared some of that, I think they would have had better performance, bank goodwill, and been less disruptible. But humans are humans. And I say in the book, like, if I was running a big active shop in the 90s and Vanguard was still niche and nobody really cared that much, I would have sponsored the sports stadium. I would have hired a ton of people. I would have given myself a raise. I just, I don't, it's just human. It's a business, and it's all legal. There was nothing like illegal about it, but unethical is a good maybe way to phrase it. Is it ethical to earn $1 billion in fees for one mutual fund? And that's one of like 30 funds you have. I don't know. I mean, but the good news is the market sorts this stuff out. And that's why, but just, Bogle introducing a low cost index fund, it became massively disruptive. There's a couple of metaphors in other businesses. I think Uber versus taxis. Ubers are easier to find. You can see when the car's coming. They're nicer generally when you get into it. They smell less. They're not as herky jerky on the brake. They're like 5 ways better than a cab. And so of course it like completely swept and you get in a cab now, the cab drivers are disgruntled. But I'm like, look, you could have cleaned the cab a little more. You could have incorporated technology. Now the cabs are starting to get, catch up a little bit. But this is not abnormal for a company to be that far ahead, come in and just utterly disrupt an area that might have been resting on its laurels and perhaps just, it wasn't maybe cannibalizing or hustling enough to sort of stave off this new competition. So if I'm a manager in doing a fund, I would just consider this, or an advisor. And the book, one of my messages in the book is throw your customers a bone now and then. It'll go a long way, especially in investing, because it's not totally your money, right? It's their money. And 2% over 50 years could mean like, if a $10,000 investment, that could be like the customer gets half of the returns and you take the other half. That's how that 2% over time, as it compounds, can be massive. So I don't know. These are all things to consider, but money managers have to earn a living too. I work at a company that these are our clients. So I think there's probably some equilibrium that will form over time between what is fair for passive and what is fair for active. Because active, you need to charge a little more anyway because you have to have a staff, you need to do research. The question is, where's the right price for investors? I think 2% probably sounds high to me. I would think it's probably going to settle around 45 basis points. That's kind of where we're seeing it in the US. The biggest active manager in the US is Capital Group. And I'll tell you right now what their fund charges. This is their ETF they just put out. And to me, this is 39 basis points. This is Capital Group Growth. So this is a world-class, the biggest active mutual fund manager in the world, Capital Group. And when they're entering the ETF space now, which is, again, a post-Bogle world, they're coming into 39 bips. That's what they've determined is the fair price for their active management. And I think that's probably around where it's going to go.
ETFs and index funds developed in the United States so much that we can say that there was a passive revolution. In Europe, ETFs and index funds are also developing, but the dynamics is not as much. We don't have passive revolution in Europe yet, at least. Would you say that John Bogle was successful just because he lived in USA, not in Europe, or in other words, if he lived in Poland or somewhere else in Europe, would he also be so successful?
Yeah, it's a good question. I think he would have been successful anywhere because when Bogle set up Vanguard, he refused to pay brokers a commission. There was no loads. This was back in the 70s when the whole system was the brokers were the intermediaries and they would get a kickback from the mutual fund to put you in it, right? Actually, it was your money, but it was a load. That's how the brokers got paid. Vanguard came up and said, we're not going to pay the brokers. The broker's like, well, never going to use Vanguard. And so that was really courageous, in my opinion, because it prolonged Vanguard's growth, because it's like separating something outside of the whole incentive system. What it did was it forced brokers, a lot of them were like, Bogle's message and Vanguard showed them that there's this other way. And some of them that gnawed at their conscience. So they said, I got to leave this place. And so they set up what we call is an independent advisor, RIAs. That's a huge wave of evolution in the US. And once you go to an RIA who is following the fiduciary standard, they almost always go passive because now they get a percent of your client's assets. So they're shoulder to shoulder with the client and they aren't dumb. They know that this is a good deal for everybody. And so the movement of fiduciary RIAs is going to be completely correlated with the growth of passive. So Bogle did that there. Now, in other countries, that movement to RIAs hasn't been as fast. So if the incentive system still says that a mutual fund is going to give you a distribution fee, well, then you're not going to use passive. But the outcomes are not as good, probably. Maybe some brokers would argue they're fine. I don't know. But that's the issue. So Bogle would have done it there because he did it here. Now, the question, though, I will say is the reason passive's slower there is because of the incentive systems. And I think over time they will change. I also think in the US, maybe there's one advantage, which is that here we are forced to be our own investors because we don't have a pension or a defined benefit where we have defined contribution plans. So we have to go to our company's 401k list, pick a fund. We have to be somewhat versed in like what a mutual fund is and what fees are. So we might be a little more savvy than other places in the world where they don't have to worry about that. You know, they get a pension plan or there's more social safety nets. US is a little more like just, you know, throwing people out there on their own. That's just how we roll here. And so I think that might also be something that might be different here. But I would assume over the years, if someone just sees a chart of like what they would get in 50 years with this fee versus that, the difference is astounding. And that's real dollars in people's retirement. So I'd have to assume over time that will take hold because it's in the person's best interest. But it is interesting to us. We study flows around the world and we sometimes are just baffled because here in the US, if a fund charges like 15 basis points, and the other one charges 10, the 10's going to get way more money. That's 5 bips. Over there, people pay 2, 3, and like nobody even cares. So it's interesting the level of cost obsession here versus the lack of cost obsession elsewhere. And in the book, I talk about there are certain people who have like carrying the Bogle torch. That said, Bogle, nothing like the real deal. You know, this guy was, in my opinion, a cross between Steve Jobs and Martin Luther, the Protestant guy. I mean, this guy was a major communicator. He was a personality, and he pounded the table on a message for 45 years. So I think there is nobody like that there, but there are certain advisors in different parts of the other international markets who are definitely, you know, into this stuff, pushing for this stuff. But those are the reasons that I think it probably is slower over there, but eventually will happen.
When we say ETF, we think passive investing, but actually ETFs start turning in the active direction. I mean, the indexes which are followed are more and more selective, and also there are new funds which are simply actively managed. They're not following the index. So what do you think? What would John say about that? Is it wrong?
Yeah, so we have a chapter in the book is called The Fall and Rise of Active. And what we think is active, the rise of passive is forcing active to evolve. This idea of holding a portfolio of stocks that's similar to the big benchmark, but then making little tweaks on the edges, we call that closet indexing active, that's probably going away. What's going to happen is people have replaced that with just an index fund. So now you own Apple, Microsoft, all the Tesla, all the companies are covered. So what people are looking for though is they want high active. So they want to use like an ARC, something that has a very concentrated number of holdings that has higher volatility. They might use they might have a trading account where they just trade stocks. I call that the hot sauce part of the portfolio. So you got boring vanilla and then a little slice for hot sauce. So thematic investing lives there. That's a new form of active. We're going to find ESG is a new form of active. Direct indexing might even be, although I'll put that aside for a second. But there's many, many ways where active is sort of evolving to sort of deal with the Vanguard effect. I think smart beta is an interesting part of active where you take a strategy, but you quantify it, and then you make an index based on the strategy. So it has rules, but it definitely deviates from the benchmark, like a value ETF or a growth ETF or a fundamentally a weighted ETF, which uses like dividends and price to sales. So smart beta to me is a really good category. In there, you're getting an active strategy for about a third of the cost, better tax efficiency, and no emotion. And so smart beta has 1.2 trillion in ETFs, and it's a tough market to get assets. So to me, when people talk about active versus passive, beta passive definitely doing well, but there's a good chunk of money going to new active and these other forms of active that might not even seem active at first glance, ESG, smart beta, but they are, even if they use an index fund or even if they track an index. So I think he would not like any of it. Remember, Bogle was pretty much a curmudgeon and a purist. He even launched the growth and value index fund, and then he would go on to crap on it. And I thought that was interesting that he was so savage that he would be savage to himself and say, "I can't believe I launched that. There's no, it's pointless distraction." He just said you need a total market index fund. He didn't even think you needed international. So again, he towards the end, as he got older, he got more and more simple to the point where he really kind of came down to the key is just to buy a total market fund, wait 50 years. And anything outside of that, he would dismiss or criticize. So everything I just said, he would criticize, of course. And I think he would criticize the thematics more than, but some things he really got under his skin, like thematics and really high active share active, crypto, those kind of things. I think he would think were really just a waste of time. I don't necessarily think that. I think if investors have a very boring, cheap, passive core, there's no harm in having a little fun, especially if it occupies your mind, scratches an itch, so that you can let the boring part grow over 40 years. Because the key to investing is compounding. And so anything to get you not to touch the core, while it does its compounding magic, actually might serve a valuable purpose. Some people, like the Bogla heads, most of them are like, I don't need to scratch any itches. I just want the 3 funds or the 2 funds, and that's what I'm all about. And that's what Bogle will be about. But not everybody's built and wired like that. So I'm not anti-active at all or anti this, but I'm, as an observer of this, I do think the modern portfolio is going to be 70% cheap 60-40 beta, and then 30% alts, high voltage active, things that are very different than the other parts of the portfolio. And that's a problem for closet indexing active, because people are like, well, I already own all the same stocks you do, just in an index fund.
Can you imagine passive funds taking all the market? Can you imagine that they reach 100% market share? This is the question which we here in Poland very often hear.
Yeah, okay. So first of all, funds, that's ETFs, mutual funds, right? If you put them together, they only own about 38% of the stock market. So even if passive was 100% of that, passive would own 40% of the stock market. Now, let's just say institutions' separate accounts are not part of that. Let's add another 10%. Now we're at 50%. There's just always going to be people trading stocks. What passive does do, though, in my opinion, is it doesn't kill fundamentals. Stocks are still going to move off of earnings. We see this all the time. But it's possible if half the money is just very still and motionless and doesn't trade, it could create more volatility in the stocks because there's less people trading them. There's less of a sort of tug of war going on. And I don't know, that's just going to be a new normal. That's probably a good opportunity for active, because if those stocks move a lot, and you're right, you could have a couple active managers who just crush it. That also should keep passive at bay a little bit, because there's always a human nature to chase the hot thing. And so I do think that passive will grow. I'm not really worried about it. I asked several people in the book what percent of the whole market could be passive, and there still be like market efficiency. And like I had people say up to 95%. As long as there's one person trading with another, the price will reflect the value of the stock. I don't know if I'd go that far, but I think that context is important. So Bogle even said if the whole market was passive, it would be chaos. But then he says, but there's just no way it's going to get that high. And I think he thought it could get to 75 without a problem. That's probably where I land. But I don't think it'll ever get to 75, simply because funds don't own as much of the stock market as people think. Foreign institutions, businesses, households. There's many, many people who own the market besides funds.
Eric, I just have one question left, and it's about you. Which ETFs do you like, and what is the way you prefer to invest? Are you more like Boglehead or more active?
I used to be a little more active. I in the 90s, I had a couple active mutual funds in my 401k. But I've since settled into the Boglean simple and cheap portfolio. I don't touch it. I did invest in a couple wild and crazy ETFs when I was first covering ETFs, because I wanted to learn about ETFs by actually, handling a couple of them. And I was in a natural gas ETF, and I learned about contango and roll costs the hard way. So I've definitely experimented a little bit with some of the more unique ETFs, but the core of my portfolio is in the boring stuff. My wife also has impact in our portfolio. She's like a Buffett kind of end of the cigar butt kind of investor. She's like, if she sees like General Electric or some classic American company trading at like $12, she's like, we should buy that. And usually it works. You got to wait a couple of years sometimes, but usually that's a good buy. So my wife does her Warren Buffett value thing every now and then, and I basically push the low cost cheap portfolio for the core, the money that matters. Our kids' college, the retirement, and then I just try not to look at it. Occasionally, though, something comes out that I'm like, maybe we should look at investing in this. But the last time that happened, I won't say what it was. It's gone down a ton. So that's why I think cheap index funds are underrated in improving investor behavior. Once you get one of those, you sort of like resign yourself to sell-offs. You're like, yeah, it's going down, but what am I going to do? Hop off of this and try to ride something for a minute and then come back? I'm like, just, So I also am like the modern portfolio in that the bulk is in this sort of like low beta passive thing. And then there's a couple things that sort of decorate the portfolio, and most of those don't do that great. My wife's stuff, I think, probably does the best.
Eric, thank you very much. To everybody who listened to our conversation and enjoyed it, I recommend this book, where you can find out more about who was John Bogle and what he did for the world of investing. Eric, thank you very much again, and see you next time.
It was my pleasure. Thank you for having me.